I'm Mehdi Sunderji, and welcome to Your Finance TV. We're here on a Friday with Jay Pelosky, and it's been one of those long, short weeks. I feel like it's been a never-ending 4th of July celebration, but I'll take it. How are you, Jay, and how was your 4th of July?
Very good, Marty. Enjoyed it as always. Got to see the fireworks, so a fun weekend. But yeah, these short weeks do always tend to feel like they're long weeks, right? So ready for Friday.
It's crazy. Ready for Friday for sure. And before we dive into your weekly musings, I just want to ask our subscribers continue to like and subscribe. And you're joining the queues very aggressively. We're over 3,000 people now. So thank you for your support. So, Jay, this week's musings, I love the title, Digestion Time, because I certainly feel like I got to digest quite a lot after this week. So, run us through this.
Yeah, I mean, I thought it was obviously the playoff of the 4th of July and the typical cookouts that folks like to enjoy. And I also put a reference into the musings into Joey Chestnut, who won the Coney Island hot dog eating contest for the 16th time in the last 17 years. So Joey's for sure digesting, and we're digesting in markets, I think, to kind of segue to what we really need to talk about. You know, markets are digesting things as well. And I think that's healthy. And I just highlight some of the big moves that we've had across assets. I mean, Nasdaq obviously got a lot of attention, one of the best first halves of the year ever for Nasdaq. But there are other big moves. Japan and Brazil, for example, were both up roughly 20% for the quarter. In the month of June, when the market started to digest the no recession call, you had cyclicals like transports and housing, both up over 10%. And then when you look to the fixed income markets, there was a report out today I saw this morning that global sovereign bond yields are now back to levels last seen in 2008. And then, of course, in the currency markets, you've had the strength of the Mexican peso and the weakness of the Japanese yen both be very dominant drivers in the currency markets, and both of those reversed over the last couple of weeks fairly aggressively. So a lot of activity, a lot of big moves, and when you have a big move, you have a big meal, you eat 62 hot dogs like Joey Chestnut, you know, you're going to need time to digest. And I think it's important to appreciate that digestion period. And for us in the markets, in terms of thinking about the investment practice, you know, we like to look and see kind of who does well as we kind of chop around and pull back a little bit. Who's weak? Is there something that we missed on the first go round that we want to take advantage of some pullback? And I think importantly for viewers, you know, our sentiment continues to be constructive as we go into the second half. We continue to think that markets are going to end the year higher, risk assets, particularly equities, and we continue to be buyers of any dips. So a little pullback, a day like yesterday, maybe slightly unnerving. Some things were down 3, 4, 5%. But on the whole, you see a nice snapback today. And I think importantly, you know, we're getting into Q2 or Q2 earnings season. So really now start to think about 2024 as the important focus point as we go forward. So digestion, let's watch how things act. Let's start to look forward into the second half of the year, into 2024, and take advantage of this opportunity.
So digestion's certainly healthy for everyone, especially I'm sure Joey Chestnuts. But there's been a theme that you touched on the last couple of weeks, and that's transitioning. And you know, I'm sure Joey Chestnut's transitioning into a hot dog as we speak, but that's not what you're referencing. What about in your musings this week? Because I see your transitioning is consistent with this week's message.
Yes, exactly, and it has been, as you point out, you know, something we've been talking about for about the last month or so. We actually titled one of our musings recently transition time. So the transitions we're talking about, there are several. The main ones are from rate hikes to rate cuts, and we'll go into that in a second. The second is kind of a follow-on from a focus on monetary policy to a focus on fiscal policy. And then the third is a natural follow-up of the first two, which is shifting from recession fears to embracing an early cycle global economic recovery. All right, so let me tackle the first two, and if I forget the third one, please jump in and remind me. So the first one is obviously front and center, the shift from rate hikes to rate cuts. We believe we're approaching the end of the rate hike cycle globally, as well as in the United States. We continue to think the Fed will not raise rates later on this month, though the market is now, particularly after yesterday's ADP surprise, the market's pricing in 90% likelihood of another 25 basis point rate hike. So even if we're wrong and the Fed does hike in July, it's already priced in, right? So there's not a lot to do there. We think more importantly, we're approaching the end of the rate hiking cycle. And we would not expect the Fed to raise rates beyond this month if they do end up raising rates, mainly because inflation, when we get the June number, which will come out before the July Fed meeting, we think inflation year over year, headline CPI, is going to be down close to 3%. So if you have year over year inflation at 3% and you have a Fed funds rate that's already at 5%, the need to raise rates beyond that, I think, is very, very debatable. And this is a global issue as well. We think the ECB, while likely to raise maybe one or two more times, is also approaching the end of its rate hike cycle. And we would note that the PPI's producer price index in Europe is now in negative territory. So deflation at the product point, and the same holds true in China. So we think the pressures for lower inflation are continuing to drive inflation lower, rate hike cycle over, and a rate cutting cycle to begin, led by the emerging markets. We've highlighted how the PBOC in China is already cutting rates. But importantly, we expect this quarter, Q3, to see central banks, perhaps in Brazil, perhaps in Chile, perhaps in Mexico, cutting rates. And so that's going to start a global rate cutting cycle. So that's the first transition, obviously very important, and particularly for us, because we believe that a Fed on hold equals US dollar weakness, which equals rest of the world equity outperformance, and also helps support commodities. And commodities have been one of the main things that has not supported the idea that we're going into an early cycle global economic recovery. So that's something we're paying close attention to. And then the second is that shift from monetary policy to fiscal policy. And here we're really talking about a term that we've all heard over the last week or two, Bidenomics, right? Where President Biden is clearly going to run for re-election on the back of the success of his Infrastructure Act, the IRA, the CHIPS Act, and the amazing amount of manufacturing construction that is taking place as reshoring and friendshoring starts to manifest. I'll just give you one stat which popped out to me. Manufacturing construction in May was up 76% year over year. So that's the new industrial policy, which we think is going to play out in the US and in the rest of the world. And it's really a key issue, Marty, because one of the big questions out there for the second half is whether the manufacturing PMIs will catch up to the service PMIs, which are well above 50 pretty much around the world? Or will services catch down to manufacturing? And obviously, if you think there's going to be a recession, you think the latter is going to happen, right? Services go weaken and manufacturing does not recover. For those of us in the early cycle economic recovery camp, we expect those manufacturing PMIs to catch up to the service sector, which is continuing to move forward given very low unemployment. We just saw the numbers today, continued real wage growth, therefore continued consumption, and ultimately, more production. So that's really a key issue for us. And there I would just highlight that even in the US, manufacturing PMIs came in below 50 again, as they have for, I think, 28 months. I believe the PMIs have been declining in the US. But importantly, the orders to inventory ratio was the best since February of 2022. And that's usually a pretty good leading indicator to a bottoming in the manufacturing PMI. So we think in the next couple of months, the US manufacturing PMI will start to pick up and break above 50. And that will put the final nail in the coffin of the recession camp, and also most likely boost the demand for commodities and some of the pricing that we're looking for in the oil segment and in the industrial metal segment.
So Jay, that leads me quite nicely into I guess your third transition, and you touched on it there as well in the second one. But how's the narrative? I guess is changing from recession to recovery, and what you're seeing.
Yes, that's definitely our point of view. We think Asia is already in recovery. I mean, China gets bashed, left, right, center every day, all day. But let's remember, China is still going to grow this year at 5% or more. That's way more than double what the US or Europe is going to grow. Let's think about Japan, which is going from strength to strength, had the fastest growth rate of the G7 economies in the first half of the year, growing above potential. Importantly, I should have mentioned it in that shift from monetary to fiscal. One of the real keys we're looking at is for Japan to move off of yield curve control, where they're artificially capped the yields on their government bond curve to try and stimulate economic activity and stimulate inflation. Right, we're all concerned about inflation being too high. In Japan, they want inflation, need inflation, because they've been dealing with deflation for the last 30 plus years. So inflation in Japan is a good thing. We think yield curve control is likely to be the Bank of Japan is likely to move off of yield curve control, perhaps as soon as later on this month when the BOJ meets. And that is going to have a big impact, we think, on the yen, big impact on economic activity and stock price performance in Japan. And as an example of that Asia recovery leading the way, and now we think the US and Europe will follow suit. So US, we feel quite confident, manufacturing going to catch up to services, unemployment, jobs good, real wage growth good. US should be in good shape. Europe, is in a little bit more of a concerning spot, right? Europe is flirting with recession. And so there we're watching closely to see if their industrial effort to deal with COVID, climate, and conflict, right? The Fit for 55, the Green Industrial New Deal in Europe, if those are going to be sufficient to kind of avert recession in Europe. And you notice that yesterday was a great example. The worst performing big market was Europe, down over 2%, was the biggest one-day decline in over 4 months. That's because rates backed up in Europe as well as in the US, and that raises fears of continued weakness in the European manufacturing side, which has really struggled more than the US, in part because of the fall, kind of the hangover from the big jump in energy prices that took place post the Russian invasion. So Europe's a little bit more of a special case that we're watching carefully. But in essence, we have really never been in the recession camp, as you know. We've always been in that middle path between high inflation and deep recession. And now we think we're segueing into a early cycle global economic recovery led by Asia, US to follow, and hopefully Europe as well.
That's great, Jay. Really appreciate you breaking down those transitions. It's very helpful to kind of get that understanding in context of everything. So that must mean that you've adjusted your model portfolios at TPW Advisory, right? So have there been any major changes? And talk us through some of these.
Yep, no, that's a great point to end, right? We'll end on the markets. The transitions are really important because, again, in global macro, which is what we kind of do, you have to have processes, you have to have kind of ways of thinking about things. And we feel like the transitions that we've been outlining and talking about are the things that we're going to look to guide us in the second half of the year. And you're right, when we do our monthly, as we did last week, the next week is always talk about process, right? The next week is always updating the models. And for new viewers, I know you mentioned that the viewership at YourFinanceTV continues to grow, as it well should. For new viewers, we have two models here at TPW Advisory. One, our global multi-asset, and our second is our TPW 20, which is 100% thematic. And so there, it was interesting. We always, we're not technicians, but we always like to check the technical positions as part of our monthly model portfolio meetings. And there, the big takeaway was that very few of our holdings are under their 200-day moving average. And usually, you want to see holdings positions above the 200-day so that can provide support, particularly in this digestive period, right, where you're probably going to have some pullbacks given how strong the first half of the year and even the second quarter or even June was for certain things. So knowing that the bulk of the models are well above their 200-day moving average is A, very different from what they looked like 4 or 5 months ago, right? And B, very comforting. And that's one of the things that allows us to say, we don't think there's a lot of downside, therefore dips should be bought. And so that's the approach that allows us to kind of take that point of view. And so in terms of the portfolio itself, or the two models, much as we have transitions in the macroeconomic space, in the models, we're running barbell strategies. So a couple of examples in the equity portfolio for the global multi-asset model, which has obviously equities, fixed income, commodities in it. We are running a barbell between the US and non-US equity. And in that non-US equity segment, we have European exposure. We have a big overweight in Japan. Last year, our focus non-US was Europe. That worked out really well. This year, our focus has been more in Japan. We continue to think Japan has a lot of upside, so we're quite overweight there. And then we have positions in our emerging market space where we think we can see the emerging markets start to really move with that rate cutting cycle in the second half of the year. So Mexico, Brazil are two big positions we have in EM. And then we continue to have exposure to China. We have reduced our exposure over the course of this year, but continue to have a position there. And there in China, we're looking for their Politburo meeting later on this month to be pretty important, as people are waiting to see some more fiscal support to help drive consumption in China. So that's something we're looking to see there. And then within the US, we have a tech and cyclical barbell. So our cyclicals worked out great in June. Transports, housing. We also have energy and industrials in that segment. And of course, in the big tech, it's been AI focused, and we are believers in the AI innovation cycle. And then switching to fixed income, we've been running a high yield and emerging market debt barbell. Pretty interesting. We have no developed market sovereign exposure, so no treasury exposure, no Bund, no JGB exposure. Our exposure is in credit, in high yield, because we don't expect a recession, and in emerging market debt, because we think the yield is compelling, the currencies are strong. Look at Mexican peso as an example. Look at the Brazilian real as an example. Currencies are strong, and the yield is compelling, and we think they're about to cut rates. Just as an example, real rates in Brazil are over 10%, and real rates in Mexico are over 8%. So there is lots of room to cut, and we think once that starts, people are going to flock to that emerging market debt. And then the last barbell, and then we'll wrap up here, is kind of an interesting one. We call it the digital and physical barbell. And so this plays both in our global multi-asset and in our tripolar world 20 thematic model. So digital, think of things like ARC FinTech or bots or bug, okay, cyber. So that's kind of the digital end of the barbell. And then the physical is the commodity side, which hasn't worked. So the digital has been a rock star. The commodities have been weak. Think oil, think industrial metals, think copper. We've been adding to our copper position based on the real explosion in the electric vehicle space. We expect copper potentially to do quite well in the second half of the year. I'm actually, when I think about, the second half and what I'm really kind of think is quite interesting and attractive, I'm drawn to the physical space, mostly in part because it hasn't performed, in part because everyone's very negative on it, and in part because if we're right on this early cycle global recovery, then the physical side should pick up. And it's interesting because much as we had a big destocking in the retail space in the US last year, and that's another reason why we think manufacturing is going to pick up this year in the second half, because there's going to be a restocking, right? Same thing has happened in the physical space. Rising rates, uncertainty about recession. So no one wants to hold inventory in the oil space. No one wants to hold inventory in the industrial metal space. So those inventories have been drawn down dramatically, which suggests that when we have a move, right, it's going to be sharp and it's going to be big because everybody's on the wrong side. So that is, and I think the catalyst could well be the manufacturing PMI, right? If we get a reading in the next couple months that U.S. manufacturing PMI is over 50, I would imagine that copper would be materially higher. So that's a segment of the model that we've been suffering with, kind of, because they've underperformed, but we've held on to it, and we've actually been adding, particularly in copper, and we think the opportunity set for the second half of the year. We like the physical setup. Digital has been awesome for the first half, and we hold those positions, but the physical is where we think we could have a nice positive surprise in the second half of the year.
Well, that's great, Jay. We'll definitely be keeping an eye out on the physical side of things because that catch up. Listen, it all makes sense. It's very logical. So we'll keep a very close eye. Jay, as always, love hearing your Friday musings on a Friday. Jay Pelosky, everyone. And you can find out more of his content from TPW Advisory at pelosky.com. The link's right there. Jay, thank you again for your time.
All right, Marty. Great to see you. And I guess Mr. Duxbury is what? It is 10th or 12th member guest of the summer.
Yeah, it seems that his club seems to have a weekly member guest, or at least two, three a week at this point. But I hope he's hitting them well, and he'll be back next week. But everyone have a great weekend, and thank you for watching.